My name's Robert Gardner, I'm Nationwide's Chief Economist, and today I'm going to talk about recent economic developments and what they tell us about the outlook, what we learned from the MPC's May decision and inflation report, and then talk a little bit about recent developments in the mortgage and housing market. So turning to recent economic data, we've seen a relatively mixed picture in the last few months. So on the negative side, the economy slowed much more than expected in the first quarter of the year. The economy only expanded by 0.1% on the quarter, which is hardly any growth at all. Consumer sector indicators were also fairly weak. So we've seen fairly low retail sales and also relatively few new car registrations, so all presenting a fairly soft picture. But on the other side, we've seen labour market data has actually remained fairly resilient. So the unemployment rate remained at a 43-year low in the first quarter of the year. Employment growth has remained very strong. And also what we've seen is wage growth edging up and inflation falling back. And that means that's eased the squeeze on household budgets, which comes a bit of welcome relief after a prolonged squeeze. As we look forward, we still expect economic activity to remain fairly subdued. We think those Brexit-related uncertainties are going to mean the economy probably expands by 1 to 1.5% a year over the next couple of years, which would be down from 1.8% last year, but still modest growth. So now turning to interest rates and what we learned from the Bank of England's May interest rate decision and what it tells us about the outlook for interest rates. So we've seen interest rate expectations move a lot over the last month. So if we go back to the middle of April, financial markets were pricing around a 95% probability of interest rates being increased in May. And then that had fallen to less than 10% chance at the start of May, just before the meeting took place. Now that was partly because of comments from the Bank of England governor, which maybe suggested the MPC had changed its thinking, but also because data for the first quarter of the year suggested the economy had slowed a lot more than people had expected, and the ONS suggested that that wasn't purely due to bad weather. But interestingly, when we look at the MPC statement, what we find is actually they haven't really changed their view significantly about what's happening in the economy and where it's headed next. They said that they thought the slowdown in the first quarter of the year was more about bad weather than maybe the ONS suggested, and even if it wasn't, they thought that the impact would be very short-lived and that we'd see activity rebound in the second quarter. They continued to suggest that they thought the economy would grow faster than its trend rate over the next couple of years, even though growth is still going to be fairly weak, still more than the economy can stand over the longer term in their view. And that meant they think that they continue to need to raise interest rates gradually over the next 3 years. So they indicated that if the economy performs in line with its expectations, they think they'll probably have to raise interest rates 3 times over the next 3 years in order to make sure that inflation hits the 2% target over that sort of horizon. So this does beg the question, if their forecasts have changed so little over the last 3 months, why didn't they increase interest rates in May, since that seemed to be what they signalled last time around? The answer is that even though they believe the economy hasn't lost momentum and they still think that they're going to have to raise interest rates in the next couple of years in order to get inflation back to target, they don't want to take any chances. They want to be sure that what they think is a temporary slowdown in the first quarter is exactly that. And it makes sense for them to be cautious because they've got an asymmetric set of risks in front of them. What I mean by that is if they make a mistake and they raise rates too soon, that's a far harder mistake to correct than if they leave interest rates too low for too long. Because interest rates are already close to zero, there isn't much scope for them to cut interest rates and breathe new life into the economy if the economy slows more than they expect. By contrast, if the economy does run a little hot and inflation does start to rise further above target, it's much easier for them to raise interest rates a little further or a little faster in order to bring inflation back to target. So if the economy performs as the MPC expects in the next couple of months, and in particular if the labour market remains as strong as it has been in the last few months, then they probably will raise interest rates again in August. However, we think that sluggish growth after that is likely to mean interest rates remain on hold for a good while after that. Turning to the outlook for the mortgage and housing markets, in recent months mortgage activity has been fairly subdued, so we've seen mortgage approvals for house purchase running about 63,000 a month, which is about 7% below the levels that we saw prevailing through 2016 and 2017. That's partly a reflection of the pressure on household budgets from high inflation and fairly low rates of wage growth, which has been acting as a drag on overall consumer confidence. And it also reflects fairly subdued demand from landlords as well. Buy-to-let has been impacted by policy changes, both tax changes and tighter lending criteria. And we think this is a pattern that's likely to persist for a while yet. So modest economic growth is going to result in still similar levels of mortgage activity over the next couple of months. We did see a bit of a pickup in remortgage activity in Q4 as a result of the base rate change. So we see overall remortgaging up about 16%. But interestingly, we did see a real jump in internal switching with activity up around 70%. So some scope if there's another bank rate change for remortgaging to pick up as well. But more broadly than that, we think activity probably going to remain close to current levels, reflecting the fact that overall economic activity is going to remain close to current levels as well. In terms of house price growth, we've seen the annual rate of house price growth in a fairly narrow sort of range of 2 to 3% over the last year or so, and we think there's only scope for a modest move outside that range over the next 12 months or so. We think house price growth will probably run at around 1% in 2018, where demand is likely to remain fairly soft, as we said, and that will exert some downward pressure on price growth, but at the same time there's still a real lack of properties on the market, and that lack of supply will continue to provide support for prices and make sure there isn't any sort of significant decline in prices, even though demand's going to be fairly soft, all things considered.